Welcome to the Demystifying Technology Podcast from the MacLaurin Group.
Typically, you go through the due diligence process. What the world of private equity
Right. Can't wait. Demystify it.
MacLaurin Group was a proud gold sponsor of this year's ACG Richmond Capital Conference. While there, we hosted a series of short conversations with experts in the private equity space to discover their outlook and areas of excitement as they look toward the coming year. When choosing a transaction advisory partner, it's important that the firm has a dedicated practice with people that possess a significant deal and industry experience. Sidney Glick of Bekaert, a full-service accounting firm, offers a unique perspective about substantial changes over the last 5 years in the M&A space, specifically relating to financial and accounting due diligence.
All right, we're here at beautiful scenic Richmond, Virginia, at the Jefferson Hotel for the ACG conference. Joining us today is Sidney Glick with Bekaert, working as a transaction services principal, if I'm not mistaken.
Correct. Thank you for having me.
Thank you for being here, Sidney. So, tell me a little bit about Bekaert.
So we are a full-service accounting firm. We have about 140 partners, 1,300 professionals, with around 25 offices from as far south as Miami to as far north as Rhode Island, and we go out west to Austin.
Okay. What is your role within the organization?
So I'm a partner in the transaction advisory space, and so our clients are all private equity firms, family offices, debt investors, as well as other senior lenders and banks. And so they will engage us to do something called buy-side or sell-side accounting and financial due diligence, which helps them evaluate the profitability and cash flows, as well as general financial and operating health of a business.
Right, the meat of the matter.
Yes.
You get a unique perspective, and I know an organization that size gets to see quite a few deals. What are some of the more substantial changes you've seen in the M&A space, especially as it relates to the financial and accounting due diligence?
Sure. Yeah, we do. We've seen a ton of deals, hundreds of deals each year. And I would say probably one of the most significant changes that I've seen over the last 5 years is historically diligence really only covered accounting and financial and traditional tax. And that was mainly for a buy-side Q of E. Over the last 5 years or so, we've seen an increasing number of private equity and non-sponsored debt lenders that are now wrapping up IT diligence and cyber diligence into the process. The IT diligence can be very robust, but at a high level, it's generally focused on understanding whether the systems are reliable, the efficiency of those systems, and whether or not they're able to meet the reporting requirements of a company. Sometimes you end up seeing companies that have adequate IT systems and infrastructure, but they're not utilizing the systems to their fullest extent. Other times you may see that there's multiple systems being utilized which aren't integrated, which can be fixed with an array of low-cost solutions. We're also seeing a significant number of sell-side quality of earnings engagements, which have become much more common in the industry as well.
Great. Can you talk about some of the key differences between the process or approach of a quality of earnings diligence assessment or assignment when working on buy-side versus sell-side?
Sure. So a sell-side quality of earnings is going to be much more collaborative and consultative in nature. And so an example is as we go through and do the quality of earnings, we may uncover certain red flags or operational issues. And these are things that may not end up in a sell-side report. The quality of earnings piece, understanding what normalized EBITDA will end up in the sell-side report, but there's other issues that may come to light. For example, if there's a certain segment of inventory that's slow moving, the inventory turns are very slow. We may not highlight that in the report, but it's really consultative sitting down with the management team and understanding why that's happening and what information can we collectively prepare for the buy side so that they're aware that the company is proactively thinking about things. And it could be something to the effect of, yes, we understand that there's slow moving inventory in these particular SKUs, and we are in the process of putting together a marketing strategy to reduce the cost to X amount. And so it's kind of more akin to when you sell your house and you think about staging the house, putting a new coat of paint, new carpet, etc., it's some low-hanging fruit, but it's things that the buyers are going to perceive as investing in a more valuable asset. So that's one of the main differences of sell-side due diligence. The other piece of sell-side due diligence is when companies are engaging in sell-side due diligence, you're identifying all of these flags, red flags on the front end. What happens is it significantly ends up increasing the probability that a deal closes. Other than that, the buy side and sell side due diligence are going to be fairly similar outside of those things I talked about.
Okay. As a potential investor is evaluating who they should be partnering with, what are the attributes they should be looking for when they choose a transaction advisory?
Sure, there's several of them that I think are important to highlight. One is whether or not the firm has a dedicated transaction advisory practice. It's important to know that there's some firms that will pull resources from their audit practice to do the quality of earnings, which is a very different animal from QOV versus audit. And so that's one really important aspect is you want to make sure that the firm that you're engaging has a dedicated practice where there's going to be folks that are solely focused on doing quality of earnings that have a significant amount of deal experience under their belt. The other piece is industry experience. I think it's really important, depending on the industry of the target, that someone is engaging a firm that has done quality of earnings assignments with companies of similar size and similar industry. And the reason is you really want to be able to leverage off of those experiences. And there's always certain industry anomalies that are important to be aware of that may affect the ultimate quality of earnings. You also want to understand what the makeup of the team is, who's actually going to be doing the work. Oftentimes it may be someone like a partner who may be selling the work or a business development officer, but at the end of the day, you want to know who's going to be responsible for interacting with the client such that communication is fluid and transparent.
One of the terms I've heard bantered about as of late is a light versus a full scope QOV. Can you, for my own edification and for our listeners, define that and what differentiates the two? Why would one organization choose one over another?
Sure. Normally it's cost driven. A QOV Lite is going to be a limited report. It's typically going to be an Excel workbook. It may include something called a proof of cash, quality of earnings, and working capital analysis. Essentially, the amount of work that's required to get to a QOV Lite versus a full scope quality of earnings is relatively the same. The key difference is really the deliverable. In a full scope quality of earnings, you're going to end up getting, generally, it's going to be 40 to 60 page PowerPoint deck. There'll be more information in there concerning customer analysis, margin trends, other operational type things that are focused on that a QOV Lite, I would say, is more focused on getting down to a run rate normalized adjusted EBITDA. There'll be other factors that I think are qualitative factors that, in my opinion, are important for an investor to be aware of in a full scope due diligence that may be lost in a limited scope project. Some other examples just may be the quality of the management team, the adequacy of internal controls, customer retention, and things of that nature.
A lot of the conversations that we've had, I keep coming back to the quality of that management team, and that is such a determining factor. If the organization it's all in a single person's purview and it all flows to a single individual, then that can become a real challenge.
Absolutely.
So when you think about that QOV estimation, I would expect that the financial statements are critical to that process and the accuracy of those. Do you find that for the most part organizations have audited that going into this process, or do you find a lot of demons hidden under the rugs when you start looking at this?
It depends. So for our practice in particular, our clients focus on investing in the lower middle market. About a third of the deals that we see are not audited. It doesn't really matter from our perspective necessarily if a company's been audited or not audited. Generally, companies that are audited are going to have cleaner financials, but it doesn't necessarily impact the quality of earnings of. As I said, we did 140 projects last year and only about a third were not audited.
Oh, really?
Yeah. When you're in the lower middle market space, generally companies are not going to be audited unless they have institutional capital that is requiring the audit.
Right. So if a company is sitting with break even or negative EBITDA, does it still make sense to even ask for a Q of E?
It does, and a lot of it also depends on the industry in particular. Many times these companies are in a hyper growth mode. We help clients assess the quality of the revenue, the retention of those clients. This is fairly common, especially when you're looking at technology space, where you'll see companies that are generating negative EBITDA, but depending on who the buyer is, if it's a strategic investor, there's a lot of overhead costs that may be cut. And so they're looking more at the quality of the revenue and the customers than necessarily how much profit is dropping to the bottom line.
No, that's a good point, because I hadn't really considered how that varies from industry to industry. At what point in the process should someone consider engaging, for a Q of E transaction advisor?
So it depends on if you're engaged for buy side or sell side. And so on a buy side project, generally, we like to get engaged as soon as the LOI is executed. It's helpful when clients can reach out at the time they're issuing a term sheet, really just to give you a heads up of, hey, we have this project coming down the pike. They may share management presentation with us, and they may ask for our initial assessment of the business based on our prior experience looking at other companies in a similar industry. And really that's more to focus on raising any potential red flags or helping our client ask questions prior to putting a formal offer in place. Once an LOI is signed, we want to get engaged right away, because the exclusivity period generally is going to run the early side 30 days, could run as long as 90 days is what we'll generally see. And the reason why you want to get the accounting guys going first is they're a lot less expensive than the attorneys. Generally, our clients will stage the service providers, and it's really all cost driven. On a sell side engagement, I would say the earlier in the process that a M&A transaction advisory firm is engaged, the better. There are many different things to consider when doing a sell side quality of earnings, aside from just trying to normalize and maximize the EBITDA of the company. And these are things that really help institutionalize the company, that you want to be able to show that management has been doing for a period of time. These may be from a reporting perspective, it may be from an IT perspective. It could also be just in the way contracts are written, and accounting guidelines are always changing, and the way that revenue is recognized on a GAAP basis is changing. And it's important that companies think about, have an accounting mind when thinking about how to maximize EBITDA, to really maximize the enterprise value of the company through its cash flows.
So how far out in front of us, the confidential information memorandum, should someone engage with transactional advisory?
Yeah, I would say a minimum of 30 to 45 days, because you want to have time for the Q of E process to complete, such that a lot of the financial and adjusted numbers can be released into the SIM. You don't want to slow that process down. So I would say a minimum of 30 to 45 days is pretty standard.
All right. Well, Sidney, thank you so much for coming by today. I've learned a lot in this process, and I know our listeners have as well. So thank you for your time. I know it's valuable, and you have a lot of meetings today, so thank you.
Thank you. I appreciate you having me.